Hey, everybody. I had to give you an update on all the safe investing. I just received an email that, boy, seems quite enticing. Interest rates seem to be ticking up a little bit in the safe investing world. So let's jump in. Bond yields. My little comment here, of course, continuing the risk in the bond world due to interest rate uncertainty. If we continue seeing any form of inflation, those Feds are going to keep pushing on those interest rates until something breaks. So just understand that there is risk in the bond world. If you're looking for a stable return, safe return, you're still going to struggle, whether it's AAA, AA, or single A. It doesn't really matter. You still have the same interest rate risk. As interest rates rise, the value of your bond goes down. So please be careful if you're utilizing bonds. This cannot be your blanket safe investment, and certainly bond funds should not be your blanket safe investment. So keep an eye on that. Very flat yield curve, as you can see, even at the treasuries. The shorter term is inverted. This is the definition of inverted yield right here. Shorter term 5.5, longer term 4.7, 4.6. All right. Then you've got the corporate bonds. You can see very flat here. The AA's and AAA's start in the high fours, end in the mid fives. You can go out 30 years on AA and hit 6 possibly as a yield to maturity. But again, be careful. Understand, as interest rates fall, you might make a little bit of money, but as interest rates rise, you certainly will lose, and that's been the problem. All right, CDs still don't make sense. I know it's been forever since we've seen 5% on one-year CDs. We're seeing 5% out there. Okay, you get into callable CDs, which this is what people aren't careful enough about. Keep an eye on your CDs. Are they callable? You will have higher rates in callable CDs because the second interest rates drop, they will call that CD and stop paying you. So be careful about your callable CDs. Okay. They still don't make sense for many reasons, but here's a real simple one. You can get paid almost the same with 100% liquidity. You've got brokerage money market accounts in the 5s. You've got high yield savings accounts in the 4 to 5s. So understand, these are paying compound interest daily, whereas most CDs are paying simple interest. There's a few companies that have come out and are now issuing them as compound, but you have a liquidity problem here, which forces you into shorter term CDs. You have no liquidity problem here. So money that you know you're going to need within a year, there's no reason not to use these money market accounts, these high yield savings accounts over a one-year CD. You get paid virtually the same amount of interest. Okay, but here's where things differ. All right, so the fixed annuity world, this is crazy. I just got this email. This is by far the highest out there right now. 5-year sweet spot of 6.45, 7-year at 6.25, which, believe it or not, I actually like more than the 5-year. This is a simple interest multi-year guarantee annuity, and there's that scary word, annuity. These have no fees, no risk. It is simply an insurance company CD. That's all it is. The insurance industry created these to combat CDs, the bank CDs. That's it. It's very simple. It's a fixed interest rate for a fixed period of time, but the big difference is very simple. They give you access to 10% of the money. If you pass away, 100% goes to your heirs. If you go into long-term care, 100% accessible. So understand, these are way more friendly than CDs, and certainly way better than any bond. I would put this 5-year 6.45 up against any bond. Remember, these have no fees and no risk, meaning if interest rates rise or fall, that doesn't affect the value of this. You will get paid 6.45 for 5 years, and at the end of 5 years, you have all your money, period. That's how this works. Okay, so there's no risk to your money in these things. There's no funny business. There's truly no fees. The insurance companies are literally in the same business as banks. They take your money, invest it however they want, and pay you the interest they promise to pay you. That's all they do. And that's what these fixed multi-year guarantee annuities are. Okay. So highest rate out there right now. I just got this email 2 days ago. Well, 2 days ago for me making this video. So the dates on this little blitz, this October rate special, applications have to be in October 1st through 31st and have to be over $100,000 to get these interest rates. And then funds have to be in by the 15th of December, before the 15th of December. So just so you know, that's the highest fixed rates available out there, certainly with no fees and no risk. That's the highest safe investment out there. But, big but on that one. If you're trying to combat inflation, so a lot of people, their priorities are don't lose your money and try to keep up with inflation. The problem with fixed interest rates is pretty simple. What if interest rates keep rising? Does 6% look good when everybody else is getting paid 12, or if inflation is 12? Right? So we've got to be careful about that. We can't put all our money in a fixed rate, no matter how good it feels. So we've got to be careful. Trust me, those of you that have been around back in the early 80s and the late 70s, and you remember interest rates back then, it is certainly possible. If we continue to see inflation, they're going to continue to push interest rates. It'll probably break something, but that's the point. To stop the inflation, sometimes you got to break things. So to combat inflation, especially when we're looking at the bigger picture, having investments that have more flexible ways to pay interest end up being much better safe investments during uncertain times. So fixed indexed annuities have become extremely popular for that reason. They are historically the best safe investment to keep up with inflation, because the way you earn interest is tied to the stock market. Now, the one thing that got fixed in the last year is the one thing that has always bothered me about fixed indexed annuities. These interest rates are called participation rates. The interest rate offering upfront is not allowed to change during the entire contract period. Period. In all the years past, and everybody that has fixed indexed annuities prior to last year, the insurance company got to change the interest rates from year to year. Well, these guys are guaranteeing the interest rate for the whole period. And in this case, they're guaranteeing them for 10 years. And if they were guaranteeing them for 20, I'd take that. This is so good. First off, the stock indices that they are offering are dynamically different. Most of the other fixed indexed annuities, they're all the same indices, or they have caps, which I typically hate caps. I really hate caps if they're allowed to change their interest rates, right? I just looked at somebody's old annuity. They started out at a 7% cap, and now they have a 2% cap. And they're supposed to be happy about that, and obviously they're not, okay? So the big difference about this is no cap, simply a participation rate. And these are participation rates that look too good to be true. But understand, the insurance companies don't invest the money in these stock indices. They could say, I'm going to pay you interest every time it's sunny in Seattle. You don't want that one, right? So understand that you're tied to a stock index. If it goes up, they pay you the math that they laid out in front, and then that's the math. They're not allowed to change. So this insurance company gives you 3 different stock indices and a fixed interest rate, okay? They have a 1-year and a 2-year strategy under each of these stock indices, and all 3 of these are completely different types of stock indices. You've got the Morgan Stanley U.S. Dynamic Equities. This is has done a very good job historically of mimicking, not mirroring per se, but mimicking the S&P 500. The volatility controls on this are like 17%. They're way out there. So they do a lot better. When the S&P's down 40, this thing's down 30. And when the S&P's up 20, these are up 16, 17, 18. So they do a very good job of mimicking the S&P 500. So more of a true stock index here. And they're willing to pay you 110% a year. Meaning if it's up 10, they're going to pay you 11% that year. Okay, that sounds too good to be true, but the real meaning, the real thing that's going on behind this is options trading. Okay, That's really how they protect themselves from having to pay more than the rest of their portfolio. The rest of their portfolio is doing corporate lending, shows up on their books as bonds, but they have billions of dollars. They can do scale. They can do $1 billion loan to a company, whereas we typically buy up little $25,000 chunks. So they have economies of scale. They're able to lend money in ways that we can't. So the majority of their portfolio is making a stable 7, 8, 9%, whereas the little tiny percent, 1 or 2%, is buying the option on this stock index in case it skyrockets. So then if it does, they get paid a whole bunch of money from that option and they push it on to you, give you that return. So at 110%, look at this. Look at this. It's the average annual rate of return. The last 10 years, its average annual return was 11.34. The high was 11.83, not much different. And then 9.72% interest on the low there. So keep this in mind. This is a great safe investment. Your principal has zero risk. Your earnings have zero risk. You can change how you earn interest. You could have 50% in this strategy, 20% in this strategy, and 30% sitting in a fixed interest rate. And the next year you can have it all in the fixed interest rate. And then the next year you can put it all in Morgan Stanley. You can do whatever you want. It's one investment with 3 different indices, 7 technically different ways to earn interest, and they can't change them on you. That's huge. They give you 10% access to the money every year. So you hit your anniversary, whatever the value of your account is, you have access to 10% of that throughout the year. 100% access if you go into long-term care, and if you pass away, 100% goes to your heirs immediately. No risk, no fees. All right, so the safe investment world has never been better. It's been over 20 years since we've seen interest rates like this, and going through such long period of low interest rates, these guys have really learned how to utilize those and invest properly using the options to be able to give you that opportunity to earn interest. So being able to earn interest like this in a safe investment, pretty fantastic. Guaranteeing those participation rates and fixed interest rates for all 10 years, never seen it in this business. This is by far the best safe investment out there right now, and honestly, ever. Because they didn't have this out there 10, 20, 30 years ago. They never guaranteed their interest rates, and now they are. So big difference. Give us a call, shoot us an email if we can help out. I used to do these safe investments review monthly. It's calmed down a little bit, but when I got that email about that fixed interest rate hitting over 6% like that, I thought it was pretty fantastic. So always happy to help out. Shoot us an email, give us a call. Always happy to talk about this and help out where I can. So talk to you soon. See you next week.